a little history lesson would be appropriate here to begin with. First of all, the first thing that the first time that this employee retention credit actually came into being was the CARES Act, and the CARES Act was passed in March 24th of 2020. But what happened was that the employee retention credit was very much overshadowed by something else that came out in the CARES Act as far as it pertains to businesses. Of course, there was the stimulus that also made the news, but there was also the PPP loan that was announced at that time. But simultaneously with the PPP loan, the employee retention credit was passed, and the employee retention credit didn't get much attention from me or from anybody here at Silvertrek or from any of our customers, really. And one of the main reasons for that was that PPP recipients were disqualified. They were disqualified from the ERC. You'll see me use ERC throughout this webinar, by the way, ERC, Employee Retention Credit. But for people who didn't take the PPP, the CARES Act allowed people who had eligible employers between March 12th and December 31st to take a substantial amount of their wages and get a credit on 50% of them. So the original CARES Act basically said that from March 12th through the end of the year, December 31st, that people who did not take the PPP would be able to get up to $5,000 per employee back. Now, of course, there was a few things that pertained to this. First was only eligible employers, right? Eligible employers. And what was an eligible employer? Well, there was a few things that qualified. We already talked about the PPP. And if you took the PPP, you were not eligible. But you had to be have a full or partial suspension of your business, TION, or you had to have a significant decline in gross receipts. And I think it's worth diving into this a little bit about what this actually means. The full or partial suspension was talking about a suspension due to an order by a government authority. So that means the federal government, that means the state government, or the local government. And what's interesting here is that they go into some detail about what constitutes a full or partial suspension in your business, including some really interesting wording about associated businesses, or businesses that you had to aggregate together for purposes of the employees. But basically, if you were fully suspended or partially suspended, then you could receive wages. You could receive the wages, or you see a credit on the wages for the time you experienced the shutdown or the suspension. So if your business, they said you were not deemed an essential business, or for one reason or another you had certain jobs that were shut down over a period of time, say it was for 2 months last spring, for those 2 months, then you could receive a credit on the wages for those 2 months. The significant decline in gross receipts is a lot broader as far as what it would allow for the credit. Namely, if you experienced where your gross receipts were 50% in a quarter, in a single calendar quarter compared to 2019. So the same quarter in 2019, if they were at 50%, then that whole quarter was a significant decline in gross receipts, and you would be able to receive a credit for that quarter and the quarter until your receipts came up again. This so what was interesting here is that a full or partial suspension happened to many people. It happened to Silvertrek in a very small way. Some of our training classes were suspended. Of course, we didn't have any in-person meetings like sometimes we do, but it was very, very limited because of our ability to telework. And since we were able to telework, then even though we had a very small partial suspension under the law, of course, we didn't have hardly any wages that were affected. Other people, that like many of you guys that had your jobs shut down, you may not have been fully suspended if some of your jobs were deemed essential, but you had a partial suspension because of some of those other jobs. And for the wages that were during that time that you had that partial suspension, you would be able to receive a credit. If you had a significant decline in gross receipts, however, it could be, depending on the size of your business, it could be all of your wages for that entire quarter, which obviously would be a lot more than just just the time that you had a partial suspension. So the other thing about this gross receipts that should be noted is that it follows the way that you file your taxes. So you're either going to be on a cash basis or you're going to be on an accrual for when you're calculating your significant decline. However, one note on your accrual is that some of you may be filing your taxes on a percentage complete, and some of you may be filing your taxes on a completed contract. And if you're filing as percentage complete, of course, that's the standard WIP process, right? Percentage completion and your earned revenue, et cetera, over under billings. Your completed contract becomes a little bit more tricky, but that would be when you closed out those jobs in those years. So the completed contract can have some fairly sizable shifts in whether or not you had gross receipts dropped. So if you were unable to close out your jobs in second quarter of 2020, for example, because of the shutdown, you were unable to get to the job to actually close it out, and you were able to close it in third or fourth quarter of that year, and you're filing your taxes on an accrual basis using completed contract method, then the second quarter may have experienced a significant decline in gross receipts. Worth looking at. So if you've determined that you're an eligible employer, then the next thing is, what are qualified wages? So our qualified wages essentially, first of all, disallow certain things. The qualified wages disallow PPP wages, but of course, that doesn't matter anyway, because under the original law, because if you had PPP, it wouldn't matter. You didn't get to participate in this program. It also disallows the wages under the FFCRA. That was the second stimulus package. The FFCRA COVID-19 paid or paid sick or family leave. So the wages that were taken as a credit for the FFCRA wages are not allowed as far as part of these qualified wages. And then, although I don't know that this is going to affect anybody in this crowd, anybody who took part of the railroad retirement tax, those were also not allowed. And there's several nuances there that come in. But generally speaking, what is allowed is for the entire year of 2020 wages. So you can have $10,000 of eligible wages, and this gets multiplied by 50%. So the credit then becomes up to $5,000 per employee. So just rough numbers here. If you experience a significant decline in gross receipts all year, then and you had 100 employees. We would we can pull up a calculator here to do the math. 100 employees times $10,000. So it'd be $1 million worth of qualified wages. Let's just say that you saw $50,000 of those that were FFCRA wages. You were at 950. It'd be that times 0.5, and you would see a $475,000 credit for 2020. So just some rough math there, depending on a lot of situations. One of the other notes about this credit is how do you actually go about claiming the credit? Claiming the credit, and for those of you who are familiar with FFCRA and the COVID, it's actually very similar to that. First of all, you can take an advance on the credit on your EFTPS, and just like with the COVID, they allow you to take everything, an advance on everything, not just the Social Security wages, but also the amount withheld. You can take an advance on your EFTPS all the way down to what you paid in during the time. If you're in the middle of a quarter, of course, since we're talking about 2020 under the CARES Act, that wouldn't be possible. And just like in the FFCRA, if you experienced where your credit that was allowed was greater than your EFTPS payment, you'd be able to use Form 7200 to request a refund. And I think they had a couple weeks to get that money to you. So that's the first way, is that you can get an advance on your EFTPS. But the way that we're actually going to be seeing this mostly for 2020 is we're going to be seeing it on the 941. And generally speaking, for all of you out there, I hope you filed your 941s for all the quarters last year. It would be on a 941X. So they're saying you can go back and refile your 941 to claim this credit. Claiming the credit is technically a either refundable or non-refundable portion of Social Security wages. So let's dive into that a little bit. So Social Security is the bucket that they're pulling from to pay for this credit. The refundable portion, the non-refundable portion, and for everybody who's filed their 941 with COVID or FFCRA wages on it has seen this terminology. This is the same terminology here, non-refundable. The non-refundable is basically saying that anything that you would have paid in for your Social Security employer wages, so this is employer Social Security wages, you can get back as a non-refundable credit for the ERC. And then everything beyond that is what's called refundable. The word refundable basically means above and beyond what you would have paid as an employer for Social Security wages. Anything greater than your employer Social Security wages. Basically, this just means that you report this in two different places, two different buckets on the 941 or 941X. So it's fairly easy. It all comes out to the same thing: $5,000 per employee, and you have you get it all back. Just how you report that back. So one other thing about claiming this credit is similar to the PPP in its early stages. This is not a taxable event. However, the related wages are not deductible. So in essence, that makes this untaxable event. Although it's not taxable income, since it's paying for wages, then the wages that are associated are also not allowed deductions. You have to pay with that after-tax money. Just keep that in mind when you're receiving this credit that once you receive this credit, if you receive it now in 2021, that you should hang on to a portion of that to pay your tax bill when it comes due when you file your 2021 taxes. Because in essence, what they've done is made this not deductible. There's no noise, as far as I can tell, about making this a non-taxable event like they did with the PPP. This does not follow that same thing. It's likely to stay in essence a taxable event. So this means taxable, income taxable is what I'm talking about here for the business or the business owners if you're a pass-through entity, not taxable for the employees. Okay, so then let's go back to the CARES Act up here on my little timeline and review. So March 12th through the end of that quarter, we had a partial quarter where you could have experienced a shutdown. Then we had a quarter 2, quarter 3, and quarter 4. And the CARES Act said that during this time, if at any time you experience any one of these quarters, you experience a shutdown or a 50% decline in receipts during one of these quarters. Whoops, there we go. That's one way of drawing it. There, okay. Then you're eligible for a credit. The credit is employee wages for the entire year, $10,000 per employee for the entire year. And this is multiplied by 50% for a total credit of $5,000, max credit of $5,000 per employee for the entire year. Okay, then at the end of last year, so that was passed March 24th, I think it was the CARES Act. At the end of last year, we had a new law, and that was actually December 27th is when the president signed it into law, and that was called the Consolidated Appropriations Bill. Consolidated Appropriations Bill, that was the one at the end of the year. You'll remember it. They had the $600 stimulus. It was also there was some allowance for additional PPP money, et cetera, et cetera. A few different things happened, but one of the main things that happened in this is it extended the law into the new year. Specifically, it extended it into Q1 and Q2 of 2021. So where the previous law had only allowed 2020, the new law was 2021. The bigger thing that this did was it said that where previously, if you received the PPP wages, you were not eligible. Now the new law allow for PPP recipients to get this. It just excludes it from the time. So if you received the PPP at the end of second quarter and you used it to pay wages sometime into the third quarter, that the wages that were paid from the PPP were excluded from qualifying wages, but the business was an eligible business. And that was a big change because previously, if you got the PPP, you were ineligible completely. So suddenly, people at the end of the year that had completely disregarded it, but had experienced a significant decline or had experienced a shutdown prior to them getting the PPP wages. For example, if you experienced a shutdown during this time period here, then the wages from here to here would be considered qualified wages during that shutdown. So this is a big deal, and probably the biggest thing that changed on that. However, it also changed some of the stuff for some of the ways that we calculate it for 2021. First of all, in any calendar quarter in 2021, our gross receipts, the gross receipts was significant decline in gross receipts was increased to 80%, or a 20% drop compared to 2019. So again, still comparing to the same quarter, but in this quarter, the quarter that we're currently in, Q1 of 2021, compared to the same quarter 2 years ago, if you have a significant drop, in other words, a drop of more than 20%, then you have the then you're eligible for the entire quarter, and that was also for quarter 2 of the same year under the Consolidated Appropriations Bill. It also, instead of it being $10,000 per employee for the entire year, in 2021 they modified it so that it's $10,000 of qualified wages per quarter. So employee per quarter. So the new law essentially said you can have up to $20,000 worth of eligible wages in 2021. Finally, it modified the 50% that you can get as a credit to 70%, allowing $7,000 per employee of credit per quarter for a total of $14,000 for the year. So you could see that instead of only being $5,000 per employee for the entirety of 2020, we see a $14,000 for the first 2 quarters of this year. One note too that this did, in the gross receipts test, it said, and this was all the way back to the CARES Act. I'm going to try to overlay this here with my yellow pen. Hopefully it shows up fine on your guys' screens. That if you experienced a decline in gross receipts in Q3, say of 2020, you got to take the credit for all quarters up to and including the quarter where you returned out of significant decline. And so even for last year, that meant that you always get 2 quarters if you experience the significant decline in gross receipts. In other words, if you experienced it in Q3, you would automatically get it for Q4, even if in Q4 you came out of that again. And by coming out of it, they said above 80%, even under the CARES Act. So if you were down, and you guys can see this in the examples that they give online, but if your gross receipts were down to say 45% of what they had been Q3 of 2020 compared to Q3 of 2019, and they were back up to 95% in Q4, you would still be eligible for the entire quarter of Q4. One of the things that this Consolidated Appropriations Bill did, though, was if you experienced a decline and you were 45% compared to 2019 in Q4, now we were able to go out into the following quarter and get Q1 instead of just ending it on Q4. So for example, 45%, you might be back in 95% here, but Q1 is also eligible. And Q1 would be eligible at the higher rate. In other words, the $10,000 per employee times 70%, or the $7,000 credit. So it also extended those affected quarters into the future, Q1 and Q2. Same thing holds true for Q1. If you experience a significant decline in Q1 of 2021, this current quarter, then we would be able to take this employee retention credit for both Q1 and Q2. So that brings us almost all the way up to the present. In tomorrow, maybe today, we don't know exactly. The machinations of government are a little bit of a mystery to all of us at this point, and if they're not a mystery, I want to talk to you because you know something I don't. But today or tomorrow, we'll just go ahead and say tomorrow, March 10th, the president is expected to sign into law the American Rescue Plan. And the American Rescue Plan has a very brief paragraph about the employee retention credit. It changes almost nothing, except that it extends it out to the end of 2021, Q3 and Q4. Everything else stays the same. It still is 80% drop. Well, I always do those upside down for some reason. 80% drop. It still is $10,000 per quarter of qualified wages. And it's still 70%, right? Which would mean that we would get $7,000 per quarter, which would mean that potentially, anyway, if you were qualified, you could get up to $28,000 per employee for 2021.
Unmuted.
If you are an affected business, this is larger than the PPP was, almost certainly. And so, again, going back to our example here of our 100 employees, if we had 100 employees and we were able to get the full amount of $28,000 for each, we're talking about $2.8 million ERC that is not a forgivable loan like the PPP was, but it's a credit, either refundable or non-refundable, on our 941. So this is a big deal for people who have been affected.
Hey, Michael, quick clarifying question on 2020 versus 2021. Was it a 50% drop in revenue and a 20% in 2021, or does 2021 require an 80% drop in revenue?
Good question. And so it's a 20% drop. Your gross receipts have to be 80% of where they were. So 2021 is a 20% drop in revenue. So they made it so that it's easier to get this. Okay, so that brings us up to the present. Actually, it brings us up to tomorrow when we're expected to see another the new law. Let's see. Is there any questions right now? Beverly asked if our business received a PPP loan. Is this webinar relevant? Yes. Because of the law, the appropriations law, they took away the need for, or the requirement, the eligible employee requirement of not receiving a PPP loan. So yes, this is. Penny, do you have to prove that the drop in revenue is due to COVID? No, you do not. You just have to prove that you had a significant drop in revenues, in gross receipts during that time. So the IRS has a very specific law about that. What I can show you here is IRS. It's IRS 2021-20. It's publication 2021-20. It's roughly 100 pages of questions and answers, but a big portion of those pages are devoted to this gross receipt test and how to look at qualifying for that. Definitely Google that. So the IRS has published this. This is official publication for 2020, but they have not published their official documentation for 2021. So we know with some certainty how the IRS is going to deal with this portion of the law that was passed on December 27th, so the consolidated appropriation. What we don't know is this portion here. First of all, they have not published any guidance for 2021 under the Consolidated Appropriations Bill of December 27th, but of course they also haven't given us any guidance on the American Rescue Plan. And until that thing's signed, then we don't know even what the law says. So this is a bit of a work in progress, like I said at the beginning. But read that, Penny, read that IRS Notice 2021-20. I'll type this in here in the chat for everybody, IRS 2021-20. It's a very good publication, has a lot of clarifying discussion on there. Cassandra, I was under the impression that in 2020, the law said employers under 100 employees could take the retention credit. However, in December, the count changed from 100 to 500. Is that still correct? Yes, Cassandra, that is still correct. What she's talking about is who is eligible for this. So in 2020, what we had for the size of employees was kind of a two-part. For the employees that had one less than 100 or less, actually, less than or equal to 100, and the people who had more than 100 but less than 500, less than or equal to 500 employees, there was two regimes that you followed in 2020, going back actually all the way to March 12th here. The employees that had less than 100 in 2019, by the way, less than 100 in 2019, you could get all wages. And for those who had between 100 and 500 employees, it was only affected wages. So what that means is, for those of you who are between 100 and 500 employees it looks like you're going to qualify because of the gross receipts thing in 2020, that you have to be able to prove that you kept people on even though you would have originally laid them off during 2020, and you can only get a credit on the effective wages, not on all wages. It's much more generous for the people who are under 100 employees. You basically can say, if we were affected, we get a credit on all of our wages. But for those 100 to 500 employees, it's only the effective wages, much smaller credit allowed, or rather, much smaller amount of the qualifying wages is allowed. In 2021, under the appropriations bill of the last part of December, and likely to be extended if this new law is signed tomorrow, it's all employees who are less than or equal to 500 get all wages for the entire portion. So people who are between 100 and 500 aren't necessarily excluded from 2020, but it's just a smaller bucket of qualified wages that you'd be able to pull from. Good question. Okay. Gay Young, what quarter is each 2021 compared to? So there's some specific law in there for people who started the business after the beginning of 2019, or people who acquired a business after 2019. Definitely recommend reading the IRS notification for details there. And if you fall into that bucket, you probably should talk to your CPA and your lawyer to make sure you're qualified. But the quarter of 2021 is compared to 2019. So these quarters, this gross receipts quarter here, 80% is compared. That's 80% is compared to 2 years ago, quarter one of 2019. This quarter two is 2 years ago. Are you at 80% or less of gross receipts compared to 2019's Q2, so 2 years ago? Dana, is there a safe harbor to qualify for ERC in Q1 2021 if you had at least a 20% drop in Q4 2020? Yes, so that was what I was talking about here. I don't know if it's called safe harbor. That word doesn't ring a bell to me as far as but if you had in Q4, you would have to have a 50% drop in order to qualify in Q1. So even if you were down to 80%, you don't qualify in Q1 here. You would have to have that. You'd have to experience that drop down to 80% in Q1. So I think your question is, if you fell between 50 and 80% in Q4, could you then be qualified in Q1? And no, I don't know of that, but it does bleed over. If you were 50%, you get to bleed over to Q1 of this year. And then if your Q1 is less than 80%, then you get to bleed over to Q2. Good question. Okay, I don't see any other questions here. Oh, there we go. Penny, just a reminder, if you have several companies under a controlled group, you have to combine employees and gross receipts. Yes, absolutely, Penny. Thank you for that. So there's affiliated company rules. Definitely a lot of the notice that I was referring to before talks about that, those associated companies. Please read those carefully, because these numbers here, the employee numbers that we were talking about down below, employee numbers here and here, those are 2019 for all associated companies or affiliated companies, not just for the individual entity. That's also true for the drop in gross receipts. One thing that was interesting to me is that the full or partial shutdown also applies there. So if you had one affiliated company that had a full or partial shutdown, then you might be able to get this ERC for the other company that was affiliated but didn't experience a full or partial shutdown. Please read those rules. There's a lot of those. John Winter says, what documentation is needed for the 2021 ERC and how is it submitted with the 941s? So the documentation to actually apply for the credit is the 941 itself. So they have a worksheet, worksheet, what is that, worksheet 5? It's the same worksheet that we've been using for the COVID credit to be able to calculate the refundable and the non-refundable portion. We'll talk about that here briefly. but they do have in that same notice all the documentation that you need in order to substantiate the credit that you're taking on the 941 in case of an audit, which is a lot more lengthy, but you don't need to submit it. Okay, I'm going to move on here so we don't run out of time to the standard reports that we could use to pull this. So basically, there's a few things that come into play. One of the biggest questions is, when did you get the PPP? So up here we said possibly you got the PPP from here to here, right? And then the qualified wages. However, for some of you guys, you might have a second draw PPP that has a portion of the wages. For example, in the second draw coming in Q1 and even extending out past Q2. How does that play into this? So we need to make sure that we're subtracting that out. Of course, we also have the COVID wages, and we have the anything else that is excluded, which we can go into some more detail on that. One of the things is that for those of you who have the PPP report, the PPP wage tracking Schedule A does allow you to substantiate the wages that you have for the PPP itself. So this is the report that we built, the premium report that we built to allow people to both to track your wages, basically the Schedule A for when you receive forgiveness. So if you have that, that should be good. If you don't have that, it's likely that you'll need to use the PR payroll register. The payroll register is a by group by ending date, so it's a little bit onerous, but you can do this and go through and calculate the amount from the time that you received the loan to the time that that amount is forgiven. So, for example, you would say if you received it on April 25th and the following pay date was paid with the PPP, you could add that up, subtract out any owner's wages that was over the $20,000 limit, and say we have, of our $1 million PPP, we now have 950 remaining, and advance along through the different payrolls on your spreadsheet until you've used up that money, and then subtract that from the qualifying wages. A little bit onerous, but not impossible to do. That would be the most difficult portion of this, I would guess. Also, because of the interaction between PPP and COVID, you wouldn't want to count the COVID wages as part of the PPP because you were obviously getting that through COVID and not through the PPP. For those of you who don't have the PPP loan at all, or it's not relevant to the quarter that you're talking about, which is a lot more likely. So these are what I'm thinking is that there's going to be quite a few people who have Q1 less than 80%, maybe Q2 less than 80%, or else it's just the following quarter, and you have no second draw PPP. You will be able to use simply the employee accumulations report. So the employee accumulations report, if you're going to run it for a specific quarter, let's just say that I was going to run it for this quarter, it'd be 3/21, and I could look at group totals, etc. I would need to have the employee totals on here because I have to remove all of the owners and the owners' relatives from this. The owners' relatives has a specific definition. It's something like sons and daughters, brothers and sisters, and uncles and aunts and nieces and nephews, something like that. But they definitely specify that. So you have to take those people out of the qualified wages. And we can run this employee accumulations. If we ran this here for a particular set, I didn't. Oh, by the way, I have this on my default. I always include inactive because nobody wants to look at your accumulations without inactive when you're filing 941s. But that's just me. Maybe it's not just me. It's me and everybody I've talked to. You also have to remove any non-qualifying wages. So we have, of course, our true earnings here, right? With a little star true earnings on this. So like we'd have to get rid of owner draws, on-call pay, payroll advance, that kind of thing. But we'd also have to remove the COVID wages from this quarter in order to calculate this. So roughly speaking, if we're going to be at 157,478 for this quarter, we would subtract out 3,104, subtract out 1,147, and we would have our 153 that we would have as our totals. This is an employee by employee thing. So now that we've subtracted those out, we can kind of get a sense for how much wages overall we have, right? Compared to how many employees. But we are going to have to go to individual employees and say, for example, for Madalena Wadsworth, we're going to have to go and say how many wages. You can see here, 6,000. It's only 6,000 because she didn't meet the $10,000 limit. 6,778 times 0.7. So there would be a $4,700 credit in Q1 for Madalena. So for those of you who are on the who don't have PPP, the easiest thing probably is to go into employee accumulations, make sure to subtract that out, and keep a spreadsheet. Fairly straightforward, really. I'm guessing that a lot of people will be able to fairly easily remove the COVID wages, employee by employee, and also be able to add in the specific health insurance from, not from the deduction side, but from the liability side. So if we went too far here, so you could say medical insurance, because medical insurance is also allowed as part of the qualified wages up to 10,000. We also, because of the need for really dialing in the PPP loan, we have created a custom report. So the custom report basically allows us to say what year we're running this for, which has different calculations, obviously 2021 versus 2020, what quarter we're running this for, because you're going to be filing this on a quarterly basis. Specifically, you're going to be filing it for on a form or 941, either 941X for previous quarters or the current 941 for the end of this quarter. It allows you to put in when you were funded, which doesn't, of course, have to be during this quarter. You can see here for this example, I'm saying 4/27, $100,000. You can specify the owners, which is just the list from the list of employees, their employee number and the owner's relatives here. And then when you run it, you get a report that looks like this. Simply gives us our employees, it gives us our earnings, it gives us our COVID earnings for those employees, any PPP wages that were used. So that's that's the tough part of this report. That's the part that we've spent a lot of time thinking through, because back here on my whiteboard, you know, we have the PPP starting mid-quarter, so all of the wages prior to that could be eligible, or we could have the PPP starting even before the quarter starts, like in Q3 of last year, for example, where you used up some of it and then it ended partway through. You can't track those PPP wages. So when we're running this report, we ask for the PPP payroll amount, and this is the amount of payroll that was forgiven. So if you had a $200,000 loan and you had $500,000 of qualified wages over the 24 weeks, right? We would only be counting $200,000 of the PPP payroll amount. However, that would all be further reduced by the amount of any, you know, rent payments, mortgage interest, that kind of stuff that you also pay that were qualified under the PPP. So this is the PPP payroll amount that was forgiven that we put in here. And so that calculates per employee, right? On this column, we add in the medical and we get our subtotal. You can see here that we said that Hillary Ponder was an owner, and so the qualifying wages is 0. And we can see here Amber had a little over 10,000, Lon had a little over 13,000, so the qualifying wages is 10,000 for this particular quarter. Because it was 2021, the employee retention credit is $7,000. This allows us then to calculate our total for the refundable and non-refundable portions of the credit. It's fairly easy to get this employee retention credit. What we certainly don't want to do is twist anybody's arm to buy this. I think that for the most part, anybody who is familiar with the accumulations report, familiar with especially if you already have the PPP report, but even beyond that, anybody who's familiar with the PR payroll register and is good at Excel, you guys can do this without having to buy anything, but we do want to make it easier for you. Our idea on this one is fairly simple. It's what if you just want to contact us. Oops, there goes my. So contact us. What we'll do is we'll install the report for free, and you can test it. If it seems like it'll work for what you have going on, then you'll pay. What we're charging is $12 per active employee. That's currently active employees, so not for the quarter that you're getting paid, and that's just one time. Then we'll finish configuring it with you. So support is totally involved in this because you're going to have to talk to somebody here at Silvertrek, most likely to kind of get the nuances of, all right, I got a loan for 200,000, but I had rent and I had this. We'd look at your forgiveness application for the PPP. Let's get it in there. Let's go in even into Vista, for example, and configure things like what earnings are particularly acceptable. You know, if we're going to be actually going into the PR deductions and liabilities to get to flag the medical leave, and going into the PR employee, sorry, not PR earn codes to flag the particular earnings. So we have to make sure that it's flagged correctly here, et cetera, et cetera. And then the last step for you and for us on this, if you buy this, is that we'll support you when you're filing your 941 or your 941X. So this $12 per employee pays for the report plus the support all the way through you actually filing. The website is an easy way to do it. I'll pull that up here. Right on silvertrek.net. You can click on this employee retention credit. We put a banner at the top, but it's just ERC resources, and then click here, get in touch. You can send an email or send this registration this way, an email to myself, an email to Jenna, or anybody here at Silvertrek would also work. Okay, you can probably sense that I'm trying to hurry because I did want to leave some time here at the end for questions. Let's try any questions of anywhere along the line, and comments or anything that I got wrong as of particular interest to me. I want to make sure that you guys collectively know more about the employee retention credit than I do. So I'm going to turn to the chat panel here, and let's see if there's any other questions that have come in. Jason says, what version are these new reports included in? And I'm not sure, Jason, depending on the reports you're talking about, the reports that I was originally talking about, so this payroll register and the PR employee accumulations are standard reports that have been available since time immemorial in Vista. I don't know when they first started. Gary, who's listening, probably knows, but it's been years and years and years. Those ones should be there for you, and those are the ones you'll need with a spreadsheet in order to calculate the employee retention credit. The other two reports that I was talking about, which was the PPP report, which was the report that Silvertrek built, and this new report here, employee retention credit, which is this is the first time anybody here has seen that. The employee retention credit are paid reports that Silvertrek has purchased, so those are not included with your current Vista install. Okay, Ben asks, are PPP wages in 2021 deducted from the ERC calculated in Q1? Yes, so any wages that you paid with the PPP loan are not qualified wages. So whether that was on draw 1 or draw 2 of the PPP, or even if your draw 1 just extended into quarter 1 of 2021. So the PPP wages are deducted from that, from the qualifying wages. Good question. Let's see here, Randy. Will this alter the preparation of the 941 like changes to the Pin 5 worksheet? Absolutely, Randy. Randy is talking about the worksheet that comes with Atrix, but it also is on the 941 941 instructions. Let's pull that up here. See if I can get to it fairly quickly. So in the 941 instructions, there is a worksheet that helps define this. This actually shows on Atrix, and Atrix helps you calculate this. Step 2, most of you will be familiar with if you had COVID pay. That was when we were doing the sick and family leave credit. So that's step 2. The employee retention credit is on step 3, and it allows us to calculate the wages, which our report will do for you, or you can do yourself with the accumulations report. And it will also separate out the non-refundable portion, that is the portion against your employer's Social Security wages, and the refundable portion, which is the amount that is above and beyond that. So yes, Randy, we're going to be filling out step 3 here. And then on the form 941 itself, let's see if that just pulls it up. Here it is. There is the 11C, which is the non-refundable portion of employee retention credit here. And of course, that changes how much we're going to have on our Schedule B, because it has to match our total deposits for the quarter, 13A. Sorry, 12, has matched 12. And then we have our refundable portion of the employee retention credit here on 13D. So we need to be changing, basically we're going to be changing 11C, 13D, and we're going to be changing Schedule B to show the non-refundable portion only. Okay. Any other questions here? We have a couple more minutes. Feel free to ask them. And if you're brave, you can even unmute yourself and ask them.
So as far as how this overlaps on the PPP, does this always grab against a full 24-week period, 8-week period? How does that work?
It actually pulls against the amount that you got forgiven. So it doesn't matter whether you're on the 8 weeks or the 24 weeks. What matters is the amount that was forgiven. So for example, let's just say that you applied, and of course it was 2.5 months or 10 weeks worth that you could get from the first draw, and you were using the 24 weeks of payroll to run qualifying wages for the PPP forgiveness. You could have easily exceeded those 10 weeks worth of PPP loans. So you might have had a payroll PPP loan of $200,000, and you had qualified wages of $500,000. But the only thing that matters is the amount that was forgiven, and they're not going to forgive any more than your loan amount. So the amount that matters is $200,000. Oh, Ben has another question here. Haven't received forgiveness in draw 1 or 2. Any suggestions how you'd approach the ERC calc? Ben, excellent question. So the first thing to know is that you of course don't know that, right? But you should be able to estimate the amount that you will get forgiven. And on draw 1, at least, you will have been able to submit for forgiveness, and you can say that this is, unless something dramatically changes, that you'll be able to receive that back. There are some words in there about people who think they're going to get forgiven, take this ERC credit based on that. They don't get it forgiven. You can go back and revise your ERC if for some reason you weren't eligible for forgiveness and you had to pay back your PPP. You should be able to go back and revise your ERC with another 941X. So basically what I'm saying is you should be able to estimate that. Oh, and Linda had the same question. So hopefully that answers your question. Do you need more clarification there? Greg, does your program, I'm assuming you mean the customer report, allow allocating the PPP to specific quarters, so that if you did not qualify in certain quarter for the ERC, the PPP wages can be allocated to those quarters? Yes, absolutely, Greg. So one of the things, I guess I can pull up the report here, but more clearly on the credit launcher here. So you can see here, I was doing this for 2021 quarter 1, but the PPP fund date was back in 2020. and the PPP payroll amount was $100,000. So it goes back and calculates from the time that your PPP was received and the amount that was forgiven. It calculates all of that and does the math for you. Basically, what we're talking about here, maybe I can draw this, is we have a situation where the quarter's wages, say let's just say Q3 of 2020, a portion of these wages might have been paid with the PPP loan. So the PPP loan may be paid for the wages of these particular people back in Q2 and Q3. And the only qualifying wages are those that have not been paid, right? So it'd be all of the wages here. And so what we had to do was apply, understand when it started and how much it was so that we could delete it out so that we could get our qualifying wages here. Good question. Okay, we are over time here. Any other questions before we go? All right, well, thank you all very much for being here. I sure appreciate it. Again, you can find the information here on silvertrek.net. We're going to be posting the webinar here and also sending out a follow-up email to all of you so that you can get it to watch this in reverse. If you have additional questions, clarifications, comments about your specific instance, you know, feel free and send us an email and we would be glad to help. Okay, I don't see anybody else posting here. All right. Well, that's it. Thank you all very much for being here. I sure appreciate it. I really appreciate all the help that we've gotten over the last year. It's been a crazy year, but we couldn't have done it without you. Thank you all very much and have a wonderful day. And here's to President Biden signing the extension of this thing. Talk to you all later.